The Money Show. Personal finance.
Personal Finance brought to you by Standard Bank, Wealth and Investment. Standard Bank moving forward. Warren Ingram, we've chatted to him already. He doesn't deserve another introduction other than good evening, Warren Ingram.
Good evening. Good evening.
Now listen, we're talking about Satrix and talking about index funds versus managed funds. Warren Buffett, who this week took us by surprise by buying some Apple shares. Let's talk about the Apple shares in just a bit because I think that's quite important. But he is quite a fan, ironically, of index investment versus active management of shares, despite the fact that he has been, all of his working life, a guy who buys stakes directly in companies himself.
Almost the poster child for active investing. I mean, that's really been how he got known in the world and how he's made such an incredible fortune. And yet, in his will, he tells the executors of his will that they need to take all the money that he's allocated for his wife, and let's just say, for argument's sake, it's $100,000. $90,000 needs to go into one index, which is the S&P 500, so very similar to our top 40 index, and then 10% basically into cash, and that's how he will look after his wife over the remainder of her lifetime. So suddenly, almost in the beginning, when it became public, almost a shocking change, for someone who's really his whole life been, saying, you can choose shares and you can buy shares, and he's done it and do way better than the market, way better than most mutual funds out there or unit trusts, and yet for his wife, he puts her money into an index.
Well, which is also interesting because he's not saying, have 90% of the money in Berkshire Hathaway, one of the best performing companies in the world over an extended period of time. He's saying buy the index, take the money away from Berkshire Hathaway because I'm no longer here to manage it.
No, I think it's slightly different. So I think what his argument when we listened to him at the annual general meeting, and it came up because obviously a lot of his shareholders are really concerned and asking, are there double standards here? What's going on? And his answer was in a way as typical with Buffett, very simple but very very powerful. He was saying that Berkshire pays no dividends. So for his wife, who will need a regular monthly income, Berkshire's not a great vehicle for her unless they're going to sell shares every month to give her an income. So where she needs a more certain income, what he says is, well, at least the index has a dividend yield, so it'll pay her dividends throughout the year. And then there's the cash buffer, which will supplement her income when there are no dividends in a particular month. So that was the first part of his answer. And the second part was that he hasn't changed his view at all in terms of investing as an active manager if you want long-term capital growth. And his view is that over a 5, 7, and sometimes a 10-year period, you might find that you can't sell your investments because they just simply have not performed as well as the index or are going down. And you need to be prepared when you buy those long-term capital growth investments to let them sit for that long before you try and realize your capital.
I mean, again, different investment styles are more appropriate at different points of your life. The younger you are, the more risk you can take, the more opportunity you can take to buy shares, the more diversified you can be in terms of investing in slightly more risky options that could deliver you a higher return. But you do get to a point in your life where you want to try and ensure not only the preservation of your capital, but you want to see some capital growth, but you want the guarantee, without paying for a guarantee, of income. And that income is what you survive on a monthly basis.
Exactly right. And then, about 8 years ago, he also put a bet out to the world to say, I can choose one investment and it will be an index. And that index will beat any hedge fund or any combination of hedge funds that anyone can choose over a 10-year period. And I'm prepared to take a bet, but if you bet with me, you have to make it a substantial bet. Let's not waste our time. And so one poor guy was brave enough or silly enough to bet against Buffett, and he said, I'll choose 5 fund of hedge funds, and the bet was for $1 million, and they were taking that bet over a 10-year period. It's now 8 years in, and Buffett's one investment, which was that same S&P 500 index, is something like 64% ahead of that basket of hedge funds.
Now, you just got to explain what a fund of hedge. Firstly, okay, what's a hedge fund? Then, what is a fund of hedge funds?
Okay, so a hedge fund is quite a wide category of investments, and the very traditional view of a hedge fund was an investment that would take a view. In other words, let's just say you had Investec on earlier. So you think Investec's a great share, so you buy it, and for every 100 Rand that you're going to invest, you invest 60 Rand as if Investec's share price is going to go up over the next 10 years. And then you take 40 Rand and you invest in exactly the opposite direction. So in other words, you hedge your bet. And if Investec really does actually fall, then you've hedged your bets, and your losses are either going to be very small, or you might actually end up making a profit if you've hedged yourself very smartly. So that's the sort of the really traditional view of a hedge fund. As with all of these things, when they become complicated, what happens was hedge fund managers with great mathematical ability decide that they want to actually borrow money. In other words, instead of hedging your bets, you actually double up on your bets, or even gear your bets and start investing. So if you believe Investec's going to go up, you actually, for every Rand that you invest, you take a 10 Rand commitment. So you really gear up your view. So that would be another form of hedge fund.
Okay, but the hedge funds generally are a lot more risky. They're not supposed to be risky, but their performance is generally not been spectacular in recent years. So this guy then takes 5 hedge funds, he puts them into a single fund, and he measures his return, and he's 63% behind where Warren Buffett is, just buying the index.
And Buffett's view was very simple 8 years ago, and he reinforced it again this year at the annual general meeting by saying, when a hedge fund charges you 2% a year as a management fee plus 20% of your great performance, if they achieve that great performance, it becomes impossible for that hedge fund over a long period of time to deliver a better return than simply buying the index, which costs you very little. And he was so confident in that bet, he just, he literally bought one thing and said, and I think he even allowed the hedge fund manager to change his hedge funds from time to time. Whereas Buffett said, I'm not going to change my view. I'm just going to buy one thing and we'll look at it in 10 years' time. And so the high fees of hedge funds, in addition to the gearing and the borrowing that they put inside those funds, he felt would always count against them over a sustained period of time. And so far he's been proved right. And I think I read an interview with the hedge fund manager that took the bet, and he just said, there's almost no chance that he can recover that outperformance of the index now, unless something very dramatic and very unexpected happens. He's almost conceded the bet already, but they'll ride it out for the 10-year period.
But look, I mean, again, it is the theory that over longer periods of time, indices do outperform. But in a South African context, where the JSE hit record levels in April last year, in April this year came very close to those record levels, but pulled back. If you're buying the index year on year, you've not made any money, Warren, and that's. To a lot of people, the index suddenly loses its appeal.
So when you say year on year, I mean for the last year or so?
Yes.
Okay, so that's true, and I think we've got to look at... And
the previous year, you probably made 5 or 6%.
Yeah. Yeah, I think that's a fair assessment. I think you've got to add a couple of things. One, that your stock market never moves up in a nice smooth straight line, and there will always be, if you invest for a typical 5 or 7 year period, there will probably be 2 or 3 years in that time where your investment goes backwards, and you need to be prepared for that when you make a long term stock investment. And that would be the same whether you bought an index or a unit trust that's active, or a Berkshire kind of a share. And you have to be patient with those times where things are underperforming. The other thing just about an index, when we look at the index, is it never includes the impact of the dividends that you are earning through the time frame. So we look at the index, and as you say, last year, let's say the index was at about 55,000 as a level, and it's now at whatever it is, 52,000 and some change. What that doesn't show you is actually through that time, companies were paying dividends, and admittedly not great dividends at the moment, but still you were earning those dividends, and you could have bought additional shares in the index at that time. So that's always just the one thing with looking just cold at an index rather than a total return is when you add the dividend to your growth rate.
No, and you most certainly must. And if you can, over a long period of time, reinvest those dividends, the rewards are multiplied many, many times through that process.
I mean, the impact is so it's so incredible that it's about half of your growth over a long period of time will come from reinvesting those dividends. So, I mean,
why don't you write a book about this?
You really should.
It's a leading question. Are we allowed to talk about it?
Well, we can. I think
just briefly, because I've got the transcript, which I'm going through, and I'm really loving it. And in there, you've got a number of case studies of how people have managed their money. And one of them, of course, is the famous Julia case study.
Yes.
And the Julia case study, and she's due to come and see us again in July. Julia's July month, or July is Julia month. And it is. And Julia's been very disciplined, and I hope she's maintained her discipline because she had a baby last year. And
bought a house.
And bought a house, and she said she was going to carry on investing. So I can't wait to see how that works out for her 12 months on 12 months. But it is that persistence and consistency in good times and bad that is ultimately rewarding.
Exactly right. And even within Warren Buffett's share price, I mean, he mentions that his share price has halved twice in his career. And I mean, so that's now one of the best investments that in the history of investing, and it's halved its price twice. So it just tells you that you just have to be absolutely patient when you make these investment decisions. And I wouldn't be surprised if we're sitting here in 12 months' time having a very similar conversation, saying the index really hasn't moved much, and I think the scary part about that is a greater number of investors will become more and more impatient with their capital, then just doing nothing, and inflation's eroding the value. So I think it's an easier conversation after 12 months, but 24 months, more and more people will start to lose the faith, and that's the problem with stock market investing is you really have to be prepared to take a 5 or 10 year view.
I got an email from John this evening. He says he's got a friend who's retired somewhere on the coast, and his friend, a clever chap, an auditor in private practice, and he thought that, I'm going to be clever about my retirement. So he had 12 million rand, and he bought bank preference shares, because bank preference shares, it's better than money in the bank. You are the first one to get a dividend out of these things, but the capital value of his preference shares has fallen very, very sharply. And since the dividend tax comes into those, the value of preference shares has depreciated very, very substantially. Preference shares used to be seen as safe as houses or safe as money in the bank. Have they lost their luster, Warren?
I think they do have a role to play. I think the trick there in a portfolio would be that it plays a small role. It plays a 5 or a 10% role in a portfolio. Okay. It shouldn't be 100% of your portfolio. And I think the one thing that the markets and a lot of us, when they came out, they were relatively new to investors, and one of the things that surprised everybody was exactly what that unfortunate man's now seeing is that they do move up and down in a very volatile fashion. So you'll find that price might well recover to some extent. It's not as if the capital will be lost forever. That we don't know, but certainly it shouldn't be 100% of your portfolio.
When you got a moment, could you do a deep dig into preference shares? Let's talk about preference shares at some point in the not too distant future.
Sure.
So I think they make an interesting discussion, because lots of people look at these things and they go, "Oh, that's easy," and then take the red or black option and put lots of money into these things, and they've made the wrong investment decision. And I mean, if you are at retirement age and there isn't fresh income coming into your account, Warren, you are dependent on what you've managed to save over your lifetime, and that's the reality.
And your first job there is to preserve your capital, and that means not just that you preserve it in. Let's just say you put in 12 million rand. It's not just saying I need to protect the 12 million rand and that must never go down. You have to protect it against the impact of inflation as well. So you do need to get some capital growth, and pref shares are not going to do that. But secondly, and it's probably something we said quite a few times over the years, is you have to diversify your portfolio over a range of cash, bonds, property, shares, local, international. You can't just take a all or nothing decision every time. That's a great way to lose money when you do all or nothing.
Finally, I nearly forgot. I've got to talk to you about Warren Buffett buying $1 billion worth of Apple shares. Now, you've told us in recent weeks, as we've reflected on Warren Buffett and his investment strategy, that he's dodged tech. He has stayed away from tech. Has Apple become so ubiquitous now that it is, I don't know, the internet superhighway's railway line, because he likes railway lines?
He does like railway lines. He likes businesses that have some kind of a moat, some kind of a competitive advantage. And I think to a certain extent that Apple does have that. I mean, I think, if you view it as a consumer goods business, then that would certainly be one of the things is, Apple is Apple. It's not as if you have an easy competitor to all of the items that they sell. But I think also his business is quite smart in terms of taking an asset that is generating good money, and when the price of that asset drops quite substantially, which did happen to Apple, and he can find a good value for it, then his business will buy it. And I think the interesting thing to me about this is, I know that the headlines are all that Buffett's bought Apple, but I'm very, very sure that it's one of the two portfolio managers that he's got working within Berkshire who've bought Apple. I'm sure it's not him, because it sounds funny, but it's only $1 billion, and
he doesn't deal in small change.
I mean, his transactions, his last transaction would be $28 billion. So those two portfolio managers are each managing $9 billion, and I'm very sure it's them. It's not Warren himself, although obviously he's very aware of what's going on. But I think that's where he delegates to the people and trusts them to do their job. What a show. We've been talking about the way Warren Buffett is such an incredible investor, probably the most famous active investor of all time. In other words, somebody who likes to buy companies that he believes are going to deliver fantastic returns over long periods of time. And yet, he tells his executors of his estate that when he passes away, the money that he's allocated to his wife needs to be invested in an index. How do we explain that?
Yeah, Warren, it's a fascinating topic and always a very interesting debate, and I think the jury's still out. But index investing, although there's a place for it, I think it's a minefield in itself. There's a proliferation of index funds out there. And the question always is, what is the right index? Is a market cap index that typically overweights the more expensive shares the right thing? I don't know. I'm not too sure that that's the right index. Or should we be looking for indices that clients can relate to, like benchmarking against inflation, making sure that they outperform inflation over time? So there's a place for index investing, no doubt, in a portfolio, but I think we shouldn't ignore active investing. As you said, Warren and Charlie are the active investors, and they've been very, very successful at it. And we have in South Africa some superb active managers that are able to add significant value to a client's portfolio. I think the challenge is often not the manager, it's the investor. How do we get investors to behave like owners? If you buy a share, you need to hold it for 5 or 10 years. Not sell out at the wrong time. Be patient. Let the managers extract that value from the particular share. So definitely a place for active and passive investing in a client's portfolio. I think blending the two is useful, but of course also combining other asset classes. But it's always best to get some proper advice and work with a financial planner.